warm welcome. My name is Brian Caplen. I'm editor of The Banker. I'm at the Royal Bank of Scotland's headquarters in Edinburgh, and with me is Ross McEwan, the chief executive of the bank. Ross, welcome. It's been a very busy summer, and obviously the startling news was that the UK has voted to leave the EU, so-called Brexit. What's that going to mean for Royal Bank of Scotland?
Well, first off, we're just a reflection of what happens in the economy, and if the economy slows down, well, our business slows down. And you've obviously seen interest rates come down further with the Bank of England changes there, which does have an impact on incomes of banks. But we are just purely a reflection of what our customers are doing. And you immediately saw after Brexit, the vote to get out, mortgage volumes came off a little bit. Commercial hasn't moved that much. The applications are down slightly, but probably no more than seasonality. But some decisions are being held off until more clarity is given.
Now, you've said that it's going to delay by 2 years your programme for restructuring the bank. Is that still your forecast?
Well, we're well and truly into our second phase of restructuring the bank. We've set out 3 phases. So the actual Brexit doesn't make a lot of difference to our restructuring of the bank. We're still coming back to being a great bank for the UK and the Republic of Ireland, with offshoots to look after corporates in Western Europe and in Asia and in the US to keep our capability there. But the point I was making was that I think the sale of the shares of the Royal Bank will be more difficult in this sort of environment, and I think we'll probably take another year or two for the government to get them away.
All right, so what year are we looking at now then?
Well, look, it's in the hands of the government. It's really Treasury and UKFI who own the shares. It's their job to sell them. My job is just to create a good bank, and a bank that does make money and has got rid of all the legacy issues, so that it's a great sellable proposition, and that's what we're concentrating.
All right, but you can't realistically sell the shares until we see some dividends. So when will the bank be making profits in order that it could pay dividends?
Well, you actually can sell the shares. I mean, the government sold its first tranche of 5% without a dividend and without a dividend in sight. Again, it's a matter of the time we pay dividend will be when we've tidied up some of the big mortgage-backed security issues over in the US, that we've removed ourselves from the Williams and Glyn obligation, and that we've got through probably another stress test. So I can't see a dividend being payable until the earliest being 2018. But it really is, we have to solve those issues first.
Okay. And let's talk about Williams and Glyn, because the plan was to do an IPO. And now you've said you've moved away from that now. So I mean, what is the plan for Williams and Glyn now?
Well, end of last year, we actually did put on the table a trade sale was a possibility. We'd had interest in the assets that form Williams and Glyn, and we did put that out there. We also saw that interest rates coming lower and being lower for longer would impact the viability of that business because of the shape it's in. So we did put that out there at the end of last year, and we are pursuing the interest around a trade sale as opposed to an IPO, and we've actually stood down the pulling out of the systems. We got 90% there. Actually, our technology was working well, was standing up, but there's no point in putting a bank out that isn't actually going to be viable and get itself a licence.
Now, selling Williams and Glyn was part of what you had to do because, according to EU rules, because you received state aid. But if the UK is leaving the European Union, does it still apply to you? I mean, could you actually just say, well, we don't need to sell it anymore?
No, I think the rules are the rules, and Article 50 hasn't been enacted yet, and there's a 2-year time frame after that. And I think it's very dangerous for countries like the UK or ourselves to say, hey, forget about it, we're coming out of the EU. The rules are the rules, and I think we should stick with the rules. And one of the requirements for us was to extract out SME capability and create more competition in the marketplace, and that's what the removal of the Williams and Glyn assets actually did, because it's actually an SME bank more than it is a retail bank, and it has its own complexities because of that, because you're dealing with very small individual customers right through to mid-corporates and all the systems and applications that go with it. So my view is rules are rules, let's get on with them, and let's honour our commitments as best we possibly can. And one of the things that people forget is there were many, many commitments that we made, and this bank is one that, I want to fulfil commitments. We sold Sempra, we sold off Citizens Financial Group, we sold Direct Line Group, we sold WorldPay, and the final piece, and I say the final piece, is Williams and Glyn. So, this bank's done what it said it would do.
No, you've definitely done a lot of work. Now, you mentioned there that you had to go through another stress test before you could repay dividends. In the last stress test, you didn't do very well, really. I mean, you were kind of like the picked out as the bank with the third highest fall in capital under a stress environment. So, I mean, how are you going to actually sort that out? Well,
first off, I think you've got to look at the starting point. We started at 15.5% Common Equity Tier 1, which was actually one of the highest, not just in the UK, but also in the EU. And what showed was that we still have a number of issues that we need to address. And these are all out very publicly in the marketplace. The mortgage-backed securities in the US is an article we need to take into consideration with our capital. When you take those items out, we ended up with just over 8%, which actually is a very good position to be in. So people took it as, my goodness, there's a problem here. Well, actually, all it shows is we've built capital knowing that we will be paying out a lot of these issues. And when you put the bank under stress, we still performed very well. We were still higher than many, many other banks that no one seemed to notice. But it was the drop. And that's a very explainable drop because of the conduct and litigation issues this bank faces.
Okay, let's talk a little bit about the conduct issues. I mean, we've settled some of them, but PPI has been extended. You've still got the mortgage-backed securities. You've still got the global restructuring group and a shareholder rights issue. I mean, when are we actually going to see some blue water out there?
Well, I wish these were all in my time that I had control over the time. If you have a look at global restructuring, that's with the FCA at the moment. We're in a process there. I would hope that that will be tidied up by the end of this year. We have a resolution to that. On the 2008 rights issue, we did go to mediation, and one would expect to go to mediation. We went in good faith, didn't get a resolution at this stage. So I think that will probably flow through to about 2023 by the time it's run through the court processes. The big one for us is mortgage-backed securities, which is business we wrote in the United States back in 2003 to 2007. So this dates back now 18 years. And is still yet to go through the Department of Justice. So again, that one is not in my time gift, but it is one of the big ones facing us. So we have a number of issues. They all, we're very focused on them, but my core focus has to be on getting this bank being great in the UK and the Republic of Ireland, because those issues are being dealt with a handful of people. And my focus has to be to get 99% of our people focusing on customers and getting this bank moving.
Okay. Now, the other thing you've got to do, and you have been doing, is cutting costs. You've got a target of a cost-income ratio of below 50%. Yes. Last year, about 72%. So where are we on the trajectory there?
Yeah, look, we have. This bank does need to cut costs. It was a global titan. I mean, it was the largest bank in the world, and it's got a cost structure that's sort of associated with that. So we have been taking the costs out. My first year, 2014, we took 1.1 billion of true cost, not when we've sold businesses, actual true cost out of our cost base. The year after, we took 984 million. This year we said we'll take out 800 million. So you're really looking at nearly 3 billion over a 3-year period of time. It's a big amount of cost, and we've still got a lot of work to do. The issue is our income is coming down as we get out of businesses. Right. So now it's for the next...
And the interest rate is so low.
Yes, and the interest rate will impact going forward a number of our businesses. So it's how do you stabilise the incomes, which start to come through in 2017, 18 and 19, and continue to take the cost down. As you stabilise the income next year, because we're taking things like global transaction services off, all the international portfolios are coming down. We've removed ourselves out of international private banking. Those businesses we did not want to be in anymore. So as we focus on this business, now our cost structure needs to come down to face this business that we're looking at.
Okay, Ross, let's come back and talk about those businesses in just a few seconds.
Yes.